Thank you very much for your interest and for joining this session. I would like to introduce Deutsche Rohstoff to you. For those who don't know us, a very brief overview of the company. The company was founded in 2006 by myself and a partner. Our focus is on the production of shale oil in the United States. We are headquartered in Mannheim, Germany, with our main subsidiaries based in Denver, Colorado, in the United States. Our stock has been listed on Frankfurt Stock Exchange since 2010, so we have quite a bit of history as a listed company. And we also have a history as a bond issuer in the German market. I think we built a good reputation as a bond issuer in the meantime, and have currently 2 bonds outstanding in the market, a straight bond and a convertible bond. Let me jump right into the numbers. We published our 9-month numbers this morning. Yeah, in my opinion, they are pretty good. We show strong growth in revenue and earnings so far this year, and we expect this to continue over the next 3 months and over 2022. So if you look at the third column with the 9-month figures, first the production in barrel oil equivalent per day. We produced 7,135 barrel oil equivalent per day in the first 9 months compared to 4,433 last year. Our forecast is 7,500 for the full year. The reason is that we'll bring a big pad online in the fourth quarter that will push the production up. And for next year, we foresee another jump to 10,000 BOEPD, which would bring us in a kind of a new league then. Revenue-wise, we saw a 65% increase to 53.2 million euro for the first 9 months. If you look at the full year forecast, it's 68 to 73 million. We confirmed with the release today that we think we'll end up in the upper range of that, at the upper end of that range. And for next year, the revenue reflects the jump in production, and we think 98 to 106 million euro revenue is realistic. As far as EBITDA is concerned, we posted a 52.1 million EBITDA for the first 9 months of this year, which is a 140% increase compared to last year. For the full year, we see 57 to 62, and again, we think we'll reach the upper end of that range. And for next year, we forecast 70 to 76 million EBITDA. Net income is for the 9 months is 21.4 million compared to a negative 14.3 last year. That's a nice swing, of course. I mean, last year was a difficult year, as everyone is aware. But I think we managed it to get through and see a very nice swing this year. For the full year forecast and for 22, we haven't forecasted a net income number, but I mean, the relations that you can see here are of course what is relatively normal for our numbers here. Balance sheet wise, there's also a major improvement to be seen. Cash is still available for the group in a wider definition of roughly 50 million euro, same as last year. Equity did a jump to 72.5 million. We, at the same time, were able to pay down our debt, the bonds. We paid back matured bond in July for 16.7 million. So the bond debt is now below 100 million, and we also paid down bank liabilities from 16.7 million last year to just 2 million left at the end of September. So overall equity ratio did a big jump from 4% last year, or 22% at the end of last year, to now 32.2%, and net debt was really reduced significantly from 92 million at the end of 2020 to just 50 million that are now left by the end of the third quarter. So overall, I think it's a nice swing, as I said, and we are happy that we are able to present these kind of numbers now. The share price reflects that improvement, of course. I mean, we saw a nice spike over the last few weeks. We are now very close to the tops that the stock reached in 2014, 17, and 18. And I'm very hopeful that we'll be able to explore uncharted territory over the next few months and see the stock moving to new highs. Our analysts that follow the stock from First Berlin and Kepler Cheuvreux have published new updates of their price targets recently. So they are both now at 27, 28 euro. And I think, yeah, that's maybe a target that we should reach over the, yeah, as I said, next few months. Let me talk about energy markets before I jump into our core business in the US. All the world is now talking about an energy crisis that occurs across the globe. I don't know anybody who predicted such a crisis 3 months ago. It's amazing how such crises all of a sudden show up and rattle the markets. I mean, I can only share a few thoughts what the reason for this crisis is, and how it may go on, and how it may influence the energy prices that are important for our business. If you look at the charts, I mean, these are the ones, the energy products that are important for us. It's WTI, it's the leading US oil brand. Henry Hub is the US gas, and NGLs are natural gas liquids. That's something we usually don't mention because it was not very important for our revenue. That has changed a little bit because they are up by 260% from compared to pre-COVID January 2020. Whereas WTI is just up 30%. I mean, it traded at around 60 at early 2020. And Henry Hub, the gas price in the US, is up 170%. That has changed the mix of our revenue a little bit. Whereas last year, 77% of our revenue came from oil, and 14% from gas, 9% from NGLs. For the first 9 months in 21, we generated 65% from oil, 21% from gas, and 14% from NGLs. So, I mean, this is mostly due to the rise of the prices, the spike in prices, but interesting that it happened that way for sure. What is the reason for that? I mean, I think there's a lot of reasons. This has been discussed over the last few weeks. I don't want to repeat them all. I think the fundamental trend that causes this problem is the one that I have on this chart here. We saw a massive underinvestment into the industry over the last 5 years. If you look at the gray bars at the bottom of the chart, you can see how the investment in the industry shrinked over the last 5 years due to low prices, due to ESG, due to talk about the end of fossil fuels and so on. And now that we see demand coming back quickly and more rapid than most people expected, we have a kind of a supply gap that can't be filled within a short time period, because it simply takes time to tap new reserves, to produce new reserves, to add it to the market. And I don't know how quickly this can be resolved. What I know is that it needs higher prices to generate the incentive for the industry to produce more. And that's, in my opinion, a good indication that we will see higher prices. Indeed, I don't know if it will be a kind of a super cycle as it is, as some people expected, with strongly increasing prices over a longer period. Could well be, but I think for the short and medium term, it is not unrealistic to believe that oil, for example, will hit $100 per barrel. And needless to say that this is not a bad prospect for us and our business. One thing that I also want to stress is that demand for oil, at least, but the same is true for gas and all other energy, fossil fuels, continues to rise, at least until 2030. Especially if you live in Germany, you may be of the opinion that fossil fuels will not be needed anymore in a few years, and we will be able to replace them quickly. This is completely nonsense, to be honest. I mean, the world is heavily relating on fossil fuels, and we can watch it right at the moment. And all the scenarios that you can find in the market, we have put in here two from Bank of Montreal and International Energy Agency, indeed indicate that we'll see rising demand instead of shrinking demand over the next 10 years at least. That's not a problem as such, but the problem is that if the world is in a transition phase and more is invested into renewable energies and alternative sources of energy, the question is, will there be enough incentive to invest into fossil fuels still, or will governments and politicians regulate the market in a way that makes it very unattractive to invest into it? I don't know, but I think again the consequence will be that prices need to go higher to give enough incentives to the industry to invest in a more and more hostile environment. I mean, that's what it is at the moment. Oil and gas are seen as something evil from many people, and if you invest into it, you are a part of that evil. What people don't want to realize is that the products that we produce are needed, and are needed more than ever. And without these products, there will be no transition into a greener future. Okay, let me leave the not talk about politics anymore, but about our business. That's more my home turf. We've built our business in the US since early 2011, so we've got a 10 or 11-year experience in the meantime. We started in Denver, Colorado, where still all of our companies are located, but we are in the meantime active in 4 states. It's Colorado, which is still the most important one for our business, Utah, Wyoming, and North Dakota, all very well-known oil and gas fields with a long history of production. In general, it's important to say that we are not an exploration company. We don't go where no one else was before. We are not Captain Kirk. We are rather a follower. We try to develop in areas where there's a lot of data available, where you know what you get, with maybe lower returns, but with less risk as well. If you look at our production forecast for next year, or let's start with 2021. At the beginning of the year, we forecasted 6,000 BOEPD. In the meantime, it's rather 7,500, as I showed on my other table. That's because we produced more in existing pads and also added new wells and acquired a couple of new wells that add to the production. Next year, we think it will go up to 10,000 BOEPD. 3,500 will come from the older pads mostly in Colorado. 4,500 will come from a new pad, which will come online in the fourth quarter, the night pad. I will come back to that in a second. 500 BOEPD from newly acquired areas, and 1,500 from development, mainly in Utah. So that adds up to 10,000 if I have calculated it correctly, and means a 33% increase in production that we think is possible in 2022. So if I jump to Colorado for a second, which is, as I said, still our most important production state. What you see here on this Google Maps image is the area 50 kilometers north of downtown Denver, where a very well-known oil field called the Wattenberg field is located. All of our leases and production is in a very small area, basically in the northwest of the field. And what you can see on this picture, and I hope you can see it, is that this is a very populated area. You can see a town here to the west. You can see a motorway that is going straight from south to north, or north to south. You have a lot of farming, you have a lot of industrial areas, and so on. Not the best, not the best for oil and gas production. There's a lot of competition for the surface use, but we managed to get through that, and through the increasing regulation over the last few years. We developed the area, and the pads that we had from north to south, the green ones to the north, were the first that were developed and put online back in 2015, 2016. And then the whale pad, Markham, Litzenberger, and so on. What we are currently developing, and it's the last one actually in this area, is the night pad here, the most western one. It's also the biggest one that we have developed so far. It's a pad with 12 horizontal wells with 2.25 mile horizontal lateral length. It's a $60 million investment, so a pretty big chunk of investment that we put into the ground here. But we think it's also going to be our best pad so far in the area. On the next slide, you can see the picture to the right. That's how the night pad looks at the moment. We drilled the wells from February to May this year, and they are currently completed. So the fracture stimulation is currently being done. It's nearly finished, so we think it'll be finished over the next few days. And then all this equipment that you can see on the picture will be removed from the pad. Some batteries and surface facilities will be installed. The gas and the oil pipeline will be connected, and then we'll be able to start flowing back to start producing. I mean, we have always said it will be in the fourth quarter. I think it'll be the next 4 to 6 weeks when we can get started. If you look at the graphic on the left side, you can see our Olander pad on the eastern side of the night pad, and then the night pad to the west. We think it's going to be a pretty good production, a pretty good investment. Not only that the costs are relatively that we are investing are relatively low due to the fact that we were able to secure relatively low prices from service companies. Some of the contracts were signed late last year already. But it's also a pad that is open to the west here. I mean, if you look at this map here, you can see horizontal wells all over the place, to the south, to the east, and to the north. There's a certain competition always between those wells and the new ones, but we don't have any competition to the west, and there is no well that can compete, and that makes it very interesting. And we think at least some of the wells that we drilled in the very west of the pad here should be very, very good wells. Okay, let me jump to Utah. That's another venture that we started in 2018 with a separate management team, and it's a bit of a different strategic strategy that we followed here in Utah. It was really a more grassroots acquisition strategy. Basically, we try to pick smaller pieces here and there, but all in the core of the field where the most activity takes place. And the management team was able to put together 2,000 net acres over the last 3 years, which is a good success. It wasn't easy, but it's now paying off because we can see that activity picks up with higher prices, and we can participate in many wells at the moment. And these wells are extraordinarily good wells, as you can see, at $55 oil. I mean, to remind you, we are currently at $80. These wells bring a return of an IRR of 35 to 75%, which is already extremely good, and this is based on $55 oil. So we think production will jump to on average 950 BOEPD next year from currently 350, and it will peak at 1500 BOEPD sometime next year. Overall, a very good success, Utah, and I'm sure we'll have a lot of good news coming out of it over the next years. Wyoming is another story that we are now pushing. Bright Rock, the company that is also active in Utah, acquired a big chunk of acreage last year at the bottom, when the market really bottomed in April 2020 for a very, very low price. 30,000 acres in the southwestern corner of the Powder River Basin in Wyoming. That's a pretty big basin, with a lot of large companies being active. You may know the names: Devon, EOG, Chesapeake, Continental. They are Oxy. They are among the huge U.S. oil and gas companies, and especially among the shale oil companies that are very successful. So they all think this basin is a very promising one, and it's worth drilling a lot of wells there. So at the moment, roughly 14 drill rigs are active in the basin. And we acquired another package, which we are not allowed to disclose at the moment, but we can add that to the map here as soon as the transaction will have closed. And that's another 30,000 net acres. So we will double our footprint here in the Powder River Basin. And with the new acquired acreage, we will also add 800 BOEPD from 17 producing wells. Closing is expected mid-October. I mean, we have the 14th of October today, so it is mid-October more or less. So you can expect that we'll be able to close this shortly. And we will then have a 60,000 acre position in the Powder River Basin. That's much more than we ever had anywhere else, and gives us a fantastic possibility to develop new production over the next years to come. I mean, I've put in here potential for 100, 200 net wells, which may be very conservative, but we'll see. That this would be an investment of up to $1 billion or so. That's something we will stretch over a couple of years for sure. So, but it gives us enough inventory to grow our business for many years. At the moment, the team of Bright Rock, as well as the team of Cup Creek, that is about to close the transaction, are preparing or are diving deeper into what we have acquired here. There's a lot of preparation work necessary to get to the point where you can start drilling. You need permits, you need technical investigations and so on. But overall, we expect that we'll be ready to drill a couple of wells in Wyoming, a couple of additional wells by mid next year. At the moment, Bright Rock is already drilling one well. This is a well that is supposed to deliver more data that is very useful for the further development. This is a picture from the pad that Bright Rock at the moment uses, and where we are completing the well. This will going to be online probably early November, and as I said, will deliver very valuable data for the further development. I mean, besides that, it's a striking difference if you remember the Google Maps build from Colorado. I mean, it's fair to say that this here is not densely populated. Actually, it's absolutely empty. It's kind of a desert, and I mean, this means there's no competition for the surface use. And this is very, very positive, obviously, because oil and gas production is something that is well received here in Wyoming. And besides that, Wyoming is a very business-friendly state in general, and makes we don't have any concern about regulation or future constraints that may come up in Colorado, for example. Okay, that was a bit of information about the current business, which is going very well. A few words about hedging. We are hedging the production that we expect over the next 12 to 15 months. We did so last year, which was very helpful because we made a 15 million euro profit from the hedge book last year. This year it's less helpful because prices increased, and then the hedges turn negative. We stated in the release this morning that in the first 9 months the hedge book cost us 7.7 million euro. And the fourth quarter is still, at least October, November, we are still hedged at a higher percentage of the expected production. That will change in December. I mean, December is in absolute terms the highest number of barrels that we have hedged, 94,500. But we expect the night production to come online, and percentage-wise, it will be the first month where the hedged volume, the percentage of hedged volume will go down. And over the next year, it will go down further. And in addition, in 2022, the prices that we were able to secure are much higher, on average $61.4 per barrel, compared to 52.8 in the fourth quarter of 2021. So our profit margin will increase automatically because of this effect that takes place in 2022. But in addition, we have hedged much less in 2022 of the expected production. So if prices continue to go up or stay at the current level, our margin will go up dramatically in 2022. Okay, a few more words about our stock and sources of income. Let me put it like that. The ones that follow our company know that we've built a portfolio of securities, of stocks and bonds in April 2020, when the market was at the lows, at long-term lows. These were all oil and gold stocks that we think we know a lot about, and I mean, if you look at the results, it was really a good decision. We realized 3.5 million euro profit in 2020, 8.5 million in Q1, 3.3 in Q2, and 3.5 in Q3 of 2021. So overall, already over 15 million this year and 3.5 million last year. I think it's fair to say that this is a good success. At the end of September, we had 3.6 million unrealized profit in our portfolio. that is still, that we can still realize over the coming month. If you look at it in a bit more detail, at the top of the slide, the gold portfolio that we bought for historical cost, for Anschaffungskosten in German, we invested 12.6 million euro. Current market value is 16 million, so we have an unrealized profit of 3.4 million. We reduced oil and gas to a very low number of just 3 million euro. At the end of September, the market value was 3.2, so another 200,000 adds up to 3.6 that I mentioned on the chart before as unrealized profit. And besides this rather short-term investments, we also have more strategic investments on the books. Almonty Industries, I don't know if you had a chance to watch Louis' presentation this morning, is a tungsten producing company with a pretty big project, new mine that is going to come online in South Korea. We have a book value of 12.1 million. At the end of September, market value was 15.9. So-called hidden reserve of 3.8 million. These are fixed assets on our balance sheet, so we don't have to adjust it to the actual price every time. We just report the book value on the balance sheet. And the second big one is Northern Oil and Gas. It's a position that we received in 2018 as part of a transaction when we sold assets in North Dakota to Northern. Book value at the end of September was 6.8 million, market value 13.4. So another hidden reserve of 6.6 million. And then there's a non-listed company in the portfolio, Rhein Petroleum. It's a German E&P company that we founded back in 2007. We have a 10% stake left in the company. 90% shareholder is a Dutch company, and they are also developing the assets of the company mainly in the Rheingraben of southern Germany and in the Allgäu region. There will be new wells drilled next year, and we think this is in the current price environment obviously a very interesting venture, and we expect to be able to sell it at some point, of course, above the book value. Another look at the valuation. I had that chart in my presentation, or I put it in a couple of weeks ago. We have updated it after, there was a lot of up and down over the last few weeks, mostly up of our peer group. So if you look at EV to EBITDA ratio, our peer group, if you take US oil mid cap as an example, trades at 6.6 times EBITDA, whereas we are trading at 2.9. If you translate, if we traded at 6.6, the share price should be 68 euro, which shows a pretty big potential. If you look at the DAX or the Nasdaq index, it's a stunning difference to the oil and gas sector. EBITDA may be a bit of a confusing, or EV EBITDA may be of a bit of a confusing ratio if you compare oil and gas companies with other companies. But overall, I think it's fair to say that the sector as such is not valued highly compared to other sectors. And our stock is not highly valued compared to our peers. Okay, so if I summarize my presentation, I think our forecast for 2022 is based on relatively conservative oil and gas price assumptions. $60 oil, $3 gas. reality at the moment is much higher. We think we are, or I just try to show that we are significantly undervalued compared to US companies. We see a massive growth potential in an undersupplied market, and I'm sure that'll be the case for a couple of years to come. Our equity portfolio still has a good potential. I mean, we haven't talked about gold. I mean, gold wasn't the favorite of the market over the last year or so, but I'm sure that'll change again, and people will realize that gold mining companies are extremely cheap at the moment. So this could be a turning point, and we think our portfolio is high quality. We'll see a lot of, we will be able to realize a lot of profit from the gold companies as well in the future. And I showed you the strategic investments, what I call the strategic investments, Almonty, Rhine Petroleum, and Northern. We see additional upside in these as well. And overall, I think a good position to be in at the moment. We wouldn't have thought that a year ago, to be honest. But yeah, it's all about timing. Thank you very much.
Great, great presentation. We have still some time left for questions. For the audience, you can post questions in the chat or in the Q&A function. And we already have some questions coming in. The first one is regarding your hedging strategy. So you paid back the US bank loan. Are you still forced to hedge 60% of your production in 2022?
Yes, the facility is still in place, and we want to use it again. I mean, it's a very flexible facility we have with the bank, so we can pay it back every time without any penalty or so, and we can draw it anytime, basically within hours, which is a very good instrument and a very valuable instrument. And now that the invoices from the fracs of the night pad will come in, we will need some of that money again. So yes, we will be forced to hedge 60% of the next year's production again. And to be honest, I mean, it's good that we are forced. I mean, it's always risky to think that you can beat the market and that you are more savvy than the market. I mean, we saw it in 2020. I mean, without the hedge book, we would have had problems to get through that downturn. We have to accept that you can't be always on the bright side. I mean, but I think, well, looking forward, our hedge book is much better than it was during the first half of the year, the first 9 months of the year. So I don't think that that's any burden. And if the market should go down again, which you never know, we'll be happy to have it at such prices, with which we can produce profitably.
Okay. So basically that also answers the future hedging strategy. Just keep the current one in place.
We will even increase the hedging for 2022. I mean, at the moment we are well below 60%, but at these prices, I mean, at $70+, I mean, it's fine to hedge more because, as I said, you never know what the future brings. There may be another black swan coming from somewhere, and all of a sudden market may dive again and oil prices back to 40s or so, and then we'll be very happy to have an average price of 70 or so hedged.
All right. The next question is regarding the bonds, which dropped in price in the early 2020s. Did you buy any back?
No, unfortunately not. I mean, we considered it, but it's legally a problem. I mean, there's obviously a gap in the legislation. You know, there's a the market abuse directive from the EU that was put in place, I don't know, a couple of years ago. And I mean, to put it simple, you as a company, you are not allowed to buy bonds back. Even if you announce it. I mean, we had that discussion with our bankers and our lawyers. Even if you put out a press release saying we are going to buy back 1 million nominal of our bond, you are not in a safe haven. You're still in danger of being a market abuser. Don't ask me why. I don't understand it. It doesn't make sense in my opinion, but it seems to be the legal situation.
Okay. The next question is quite a long one. Cup Creek's production in Wattenberg field is having a relatively low oil share of 40%, while Bright Brock's production in Wyoming and Utah is double of that. The total production has only an oil share of 45%, while the peer group like NOG has 60% oil. How do you think that Deutsche Rohstoff can increase its oil share of production? And what do you expect from Wyoming acreages in terms of oil share of future production?
I'm not completely sure where these numbers come from. I mean, in general, at the moment, I'm pretty happy that we have gas and NGLs in the portfolio, because as I showed, I mean, the prices sought and are even better than the oil prices. I mean, gas prices at a certain point, at least in Europe, were at, if you compare it to oil, were at $200 compared to a barrel of oil. But yeah, I mean, anyways, I mean, there's not much we can do about it. I mean, it's all produced from the same well. There's differences between the different oil fields. North Dakota, for example, has very little gas. It's mostly oil. And even if it has gas, it's not worth a lot, because the way to bring it to the consumers is very, very long. I mean, it's far off anything. So it's simply a different basin with different share of or different portfolio of product that comes out of a well. In Wyoming, we expect it a bit more oily than Colorado, I would say, but it also depends where you are in the field. I mean, there's differences in one oil field. Some parts, especially some parts are more gassy, some parts are more oily, so it's hard to say in general.
Okay. The next question is regarding the future. Are there any plans for the future production for 2023 and beyond in terms of BOE per day? And where do you see the Deutsche Rohstoff in 2025 in terms of oil production or strategic metal projects?
I mean, we haven't published any numbers for 2023 or beyond, which has to do with what I tried to explain. We have to do our homework for Wyoming, especially get the permits, do the technical work, and then determine how we want to tackle the whole thing. This vast area of 60,000 acres. I mean, that's a pretty big area, and we will need a strategy how to develop this area. This is still ongoing, and we'll, as I said, we think by mid next year we'll be ready to get started, and then we'll also be in a position to forecast 2023 and beyond. In 2025, I think it's as I said. I mean, we through the acquisitions in Wyoming, we have a very big inventory of new development that we can bring online, and in 2025, I would guess we are still developing these areas, and it'll give us a lot of growth potential for the next 10 years, basically.
And what are the production costs in 2022 compared to 2021?
I mean, we don't have any production in 2022 yet. It hasn't even started. I don't think it'll change a lot. I mean, what we see in the US market at the moment is all but a boom. I mean, it's not booming. It's if you compare it to 2014 or 2018, it's a complete completely different environment. I mean, back in 2014 and 18, everyone wanted to invest into the oil sector because it was booming. Everyone thought it can make a lot of money in it. In 2021, it's completely different. I mean, many people are pulling their money out of the sector. I mean, maybe you saw a Harvard endowment fund releasing a couple of weeks ago that they won't put any money in oil and gas anymore. That's very typical for the US market at the moment. People are scared to invest into oil and gas. They may, I mean, they want to be rather on the green wave, and that's limiting the market. And that's what we are seeing. And that means the service companies can't increase their prices as they were used to in boom phases in the past. So we don't pay more at the moment for services. So I don't expect 2022 to see huge price increases. So yeah, short answer to the questions, I don't see a big difference to 2021.
And a question regarding the gas prices. What kind of implications does the gas price have for you, and do you also hedge it?
Yes, we do also hedge it. We are also forced to hedge it. I could add, which is not true for NGLs. Gas prices, yeah, I mean, it's linked to oil in a way because it's produced out of the same well. I mean, if you take aside wells that are drilled just for gas, which also exists, of course, but overall it's the same story. I mean, there's no greed or so, no boom ongoing. People are still very cautious to invest into a new development. As far as gas is concerned, there's another limiting factor. It's infrastructure. I mean, gas is always transported through pipelines, and especially at the East Coast, where most of the gas reserves of the United States are located. It's very, very difficult to build new infrastructure because there's a lot of opposition against it. For whatever reason, that makes it very slow to develop new pipeline projects and to bring the gas to the customers, which are at the coast, of course. I mean, it's a very good situation the United States are in. They have the gas at the East Coast and they have the consumers at the East Coast, but it's not easy to get the gas to the consumers. So that's limiting the gas. Investments and will keep prices probably higher than we saw it over the last few years.
And one last question is regarding how competitive you are versus the other big global oil companies on the market.
I don't think we compare ourselves to Exxon or Shell or so. I think we are a niche player. We try to keep our costs keep our costs down. We have a very small team. We are very cost effective and conscious. So I think we are very competitive. But I mean, as I said, we are not competing with Exxon. They are much bigger. Obviously, they are looking for much bigger assets, which are not of interest for us. I mean, they wouldn't look at our interest at our assets because they are way too small for them. But I think compared to the guys we are competing with, we are in a very good position.
Perfect. Yes. Thank you. That were all the questions. Thank you for the great presentation.